Welcome everyone to our October edition of On Track, where we'll look at news up to date, date of recording 26th of October, and performance of financial markets up to the end of September. Rob McGregor here, and hope you are all well as we enter an interesting stage post-COVID. Before I get started, just want to say, as always, this presentation is designed for clients of McGregor Wealth Management, particularly those using the CARE methodology and portfolios. Anyone else, you're welcome to listen, but please seek out advice or do your own research before acting on anything we talk about here. What we're going to cover today is some of the latest economic news, put it into context and perspective, which is probably the most important thing that we think we do. Go through the key market updates, look at the returns. I'm going to talk about a couple of themes today. One is the pandemic and the unvaccinated, as I believe we have come to the end of the pandemic for the vaccinated, and I'll talk about why. I'm going to talk about inflation. We've seen news about inflation coming back, and I know there's some fears out there that it's going to turn into permanent inflation, what impact that might have. So I'm going to touch on whether I think that's transitory or trend. We'll have a look at the economy. Property prices still going. How high can they go? We'll talk about that, and as always, try and put it all into perspective. So let's have a look at some of the news that's come out since we last spoke. Vaccination rates are increasing globally. I mean, we've got 52% of people globally that have had one dose and 38% two doses, but that's a story of two worlds, the developed world and the undeveloped world. And you'll see in the chart in the middle of the top there, you've got countries like Singapore, UK, Spain, New Zealand that have got fantastic rates, and that's percentage of population that's fully vaccinated. Australia's moving up that reasonably well. We're sitting at about 60% across the board. But once again, even in Australia, we've got a tale of two areas or more. We've got Melbourne and Sydney, very high vaccination rates. Canberra's actually got the highest vaccination rate in the world. But as we go into regional areas, less so there. And then you go into the other states and less so again. And I'll touch on that as we go through some of the vaccination updates. So we're seeing New South Wales and Victoria come out of lockdown. And ironically, that's going to mean states like Queensland, where I'm recording from, and WA are going to stay locked in, at least for the foreseeable future. I think we've got a rocky few months. I think come March of next year, hopefully we're all on the same page. But I think we're going to see some people in Sydney travelling to LA before they can travel to Perth or Brisbane. And we're hoping here in Queensland, we are going to be allowed to welcome visitors before Christmas. But at the moment, that's dependent on an 80% vaccination rate being reached by December 17th. If that doesn't happen, I'm not sure what's going to happen. I'm hoping we're going to open up anyway. And I think the latest indicator from our state government is that that would be the case. And if any areas that would be below 80% got any COVID cases, then they would be locked down. Southeast Queensland's looking pretty good for those numbers. That's the Gold Coast, Brisbane and Sunshine Coast, but the rest of the state, not so good. So we'll see what happens there. The RBA in its monthly minutes predicted that the economy will be back to its pre-COVID path by the second half of 2022. That's good and amazing news. So that's not just back to where we were, that's back to the trajectory of the growth that we would have had without COVID. Now it's taken massive amounts of government stimulus and Reserve Bank spending, both here and around the world, but it's also taken a very adaptive and responsive private sector. So that's good news. That's led to one of the other things there, some potential fears about inflation, which I'm going to cover off on. US company profit season is just sort of drawing to a conclusion, and 65% of companies beat expectations. US profit numbers have had incredible growth. If we go back to the lows post the GFC, earnings per share is up about 8 times from that abnormal post low. So US companies are very profitable, and that's been a part of a driver of share markets around the world as well. On the downside, we had the news continuing of the collapse of the Chinese property developer Evergrande, and that spooked the markets a little bit. I just want to put that in perspective. Their debts are around 400 billion, and as the media and throws numbers around like that, it makes it sound really big. But just to put into perspective, China has 1.4 billion people, so that's $3 per person in China. So that tells you, when we're measuring trillions of dollars of company net worths now, it puts that into perspective. And that also fails to consider the fact that Evergrande has assets, which no doubt will be sold. Although Evergrande bonds, for people that hold them, which is mainly local Chinese and a few bigger global companies, are selling at 27 cents in the dollar. A reminder that the bond market can also be highly volatile. That means people that invested in those bonds, that company right now would only get 27 cents in the dollar back. My thoughts and our investment committee and others that we talk to, it's unlikely to have a big impact on the world economy. It'll certainly have some impact on China's economy, but not significant that it's likely to derail world growth. It doesn't mean it can't, but it certainly was a catalyst for the market to have a bit of a pullback in September, which was probably overdue. So also out of the Reserve Bank minutes, they talked about wage pressure remaining subdued in Australia. So that means we're not, even though we're seeing a little bit of inflation, we're not seeing that flow through to wage pressures for pay increases. Now, the Reserve Bank would like to see a little bit more of wages going up. Wages are going up by about 1.7%. At the moment, that's about exactly the same as inflation. Generally, the Reserve Bank would like to see wages increasing at just above inflation, say 1% above inflation, and they would like to see that increasing as a result of productivity. But we've got obviously a COVID economy at the moment where people aren't working to their full extent. Some people have dropped out of the job market, so it's very hard to read the job market until we come out of this in 22. And we're continuing to see the amazing rise of house prices across Australia. Crazy here on the Sunshine Coast as I speak, but equally everywhere we look, and I'll show you the numbers, we're up. Not much change to the key numbers on the right-hand side there. RBA cash rate still 0.1%, 90-day bank bill rate 0.04. That's pretty much zero. So it's up slightly. It doubled from last month, but from 0.02 to 0.04. 10-year government bond yield stuck its head up a little bit as those inflationary worries started to come in. And that's pretty much, I'm going to talk about, but the 10-year bond yield is pretty much the market's best guess at what inflation is going to be over the next 10 years. So you can see that's still incredibly low. Aussie dollar a bit stronger, up to 75 cents. We're seeing inflation, the temporary number at 3.8%. The look-through numbers close to the 1.7. And I'm going to talk about, as I said, whether that's a trend that we're actually at higher inflation or whether it's a transition phase. Mortgage rates still incredibly low. One offer, the lowest one I could see this month was 1.59%, quite crazy. The average about 2.93. But we got two tiers there. We're seeing new loans being done in the twos, occasional ones. Older loans, when we get clients in, are often still in the 3.5. So I can't highlight enough, tell everyone to review their mortgages. If they've had their mortgage for more than a couple of years, they're probably paying 1% over. 1% on $1 million, which is not an uncommon mortgage, particularly if you take into account investment loans, is $10,000, a significant sum of money. So worth refinancing, worth renegotiating. We're always happy to talk about those things with you as well, where appropriate. 1-year term deposit rate still quite pathetic at 0.3%. To put that in perspective, that means someone with $1 million in the bank gets $3,000 a year of interest. Keep in mind, a couple with nothing in the bank gets nearly $38,000 actually from the Australian government in the form of the age pension. But someone who doesn't qualify for an age pension, who had $1 million in the bank, would only get $3,000 a year. And that's driving people to look at the share market, which is supporting the share market. Bottom chart in the middle there just shows Australia still recovering from our Delta variant, but starting to come back after Sydney and Melbourne locked down. Obviously, our two biggest cities and our two biggest states, that put a handle on a dent in economic activity for the September quarter. And we had negative growth in the September quarter, but that's starting to come back and should come back strongly as we come out of lockdown. So let's have a look at returns, and I'll just put our market view out there first. But with the market coming back and profits increasing, we've dialed the notch back, and we think the market is just a little bit above fair value. It's certainly not in any alarming area whatsoever. And with interest rates incredibly low, there's not too many alternatives for investors. So a healthy share exposure is pretty essential for most people to get a decent return. Our targets there for the various different risk profiles, inflation plus 2, 3, 4, 5, 6, depending on your risk profile, and you can see the portfolios continuing to deliver above those targets. And our goal, as always, is above average returns and below average fees, and something which we are consistently hitting. 1 year numbers still high as they show the recovery from COVID. 3 year numbers are kind of the normal ones, and 5 year numbers healthy as well. You'll see down the bottom, I've included that Genuine Edge portfolio, which I talked about before, which is a portfolio we've designed for our younger clients or for excess funds for our retired clients. And that is funds that they're not likely to spend during their lifetime. So they're investing effectively for their children or grandchildren. So it's a portfolio that I'll probably feature next month, but it includes areas like emerging markets, in particular India, artificial intelligence, robotics, global healthcare, global small companies. So they're areas that we know have a high probability of outperforming in the long run, but will also be more volatile. So that's why they're suitable to younger clients who've got a long time frame before they can access their money, particularly in their superannuation. So good returns across the board. We'll break that down shortly, but just want to repeat, as always, our context. So we've got the markets at around fair value, some of them at just a little bit over fair value, some of them at between fair and expensive, but that's in the zone of what we would call the wall of worry, which is that zone of the market that we're in most of the time, where the market's going up most of the time, but it's worried about stuff. At the moment, the market's worried about a lot of things: COVID, Evergrande, inflation, all the government stimulus. So there's lots to worry about, but the market keeps going up. And it does that because companies' profits keep going up, which we've seen in this profit reporting season. Now, eventually, and we're not in this category at the moment, but that wall of worry, people actually start to stop worrying and the market breaks out into a boom. And that boom eventually reaches FOMO, which is the fear of missing out. And all those booms are eventually followed by a bust. And we then recover from that bust and re-enter the wall of worry. We haven't had a boom since the GFC. We certainly hadn't had a boom, and the COVID downturn was the first major downturn that is more than 25% drop in the market that wasn't caused by a boom and bust, but rather caused by a pandemic and the shutdown of the global economy. So that's those top 9 downturns, and always good to know what we're being wary of there. And we're well and truly out of the number 5 one, which was the fastest recovery. And I won't dwell on that. And I'm going to reframe some of the concepts I'm talking about today around this framework, that most investors out there mess it up because they're zigging when they should be zagging when they should be zigging. And I've seen that. I had a few queries from other advisors that we mentor about things like that. Clients saying, "Oh wow, is China going into a GFC because of Evergrande?" I said, "Well," and that's worth revisiting. Where someone comes up with a single issue obsession, they get very emotional based on stuff that comes out of the media, and they don't put it into perspective. And in this case, this particular investor wanted to go to cash. And they actually said they wish they'd gone to cash before the COVID pandemic because they lost money, missing the point that they'd since recovered all that money. So that misbelief that you can time markets when nobody actually can. So these are things that stop people from having great long-term results because they get caught up in the short term and they mess it up. And the things I'm going to cover off today fit into that. So firstly, the biggest short-term obsession of our lifetime, which is COVID. But I wanted to put, I'm always looking ahead to where we're going. So, I'm looking at what's happening overseas, and particularly the UK. But there's an interesting news article that came from the GP newsletter. So that's all the general practitioners, doctors in Australia. But this came out in September, and it was the headline here: unvaccinated patients dominate COVID deaths in ICU. So what they're saying here is that most people who've died from COVID-19 in New South Wales, and this came from a detailed report from the New South Wales Health Department that looked at these numbers, and they said most people that died had not received a vaccine, and while no one under 70 has died having received 2 doses. So, and I'll pick out some stats out of this article. This was a report from the 2 weeks, from the week 29th of August till 4th of September. And during that period, 4,654 people were hospitalised. And that was about 9%. So 9% of those were treated in the ICU. And when you look at the total admitted to hospital, 3.3% were fully vaccinated. So once again, most of those are elderly people that are fully vaccinated. 18% partially vaccinated, 1 dose, and the rest, which is 80%, close enough, were unvaccinated. So, and that's why I'm talking about this is becoming a pandemic of the unvaccinated. For those who are fully vaccinated, this is just another of life's risks, but down there with the usual suspects. So this is now a major risk only for the unvaccinated. And the impact that has on the rest of us is the clogging of the hospital system. So you'll remember right back at the start of the pandemic, it was critically important to flatten the curve. And that was to stop the ICUs, to stop the hospital system from being overrun. Now, we've actually achieved that to a degree. So if you look at the top chart here in the UK, you'll see the dark blue line shows number of COVID cases. And we saw it peak in December last year, plummet, and then come back with Delta. And then as vaccination rates increased and the UK opened up, we saw that cases stayed up around the 30 to 40,000 a day. And for people reading the news and focusing on new cases, they go, wow, that's really bad. But the thing that actually matters going forward is not the number of cases, it's the hospitalizations. And you can see this blue line here, which is going sideways, and the new deaths, which is also going sideways. And they experience the same thing. Those hospitalizations and deaths are from the unvaccinated and predominantly still the elderly. So we're seeing similar results in Australia. And let's get some perspective. Our cases are peaking out at around 2,000 a day compared to the UK at 40,000 a day. So we have a vastly less COVID experience in the UK. But we're starting to see hospitalizations go sideways and the link broken. In the previous peak of COVID last year, we saw cases go up and we saw hospitalizations and deaths go up with it. And now we're seeing that start to go sideways, very consistent with the UK experience. And that's good news for how we get out of this. Not so good news for the unvaccinated, particularly those with either who are elderly or have multiple conditions. And we're going to see still that be the biggest stress point on our hospital system as they have to admit people who are unvaccinated with COVID. So yeah, the way out of this as always has been vaccinated. It's not something that everyone wants to do, and I take my hat off to the young population of Australia who are at no risk, no significant risk of being seriously ill or dying from COVID, but who've rolled their sleeves up to protect the elderly and the vulnerable. Yeah, and quite an amazing phenomenon. So next one I want to talk about is inflation. And as we've seen inflation come out, so this chart shows inflation going back to 1960. And in about 1970, we had inflation sneak out of the bottle, and all of a sudden inflation bounced up, continued up to a peak of about 15% in the late 70s, early 80s. And then it took literally 20 years to get it back under control. They have the same target as us, around 2.5%. So it took till 1995 to get it down to that level. And all of a sudden, we've got this little breakout at the moment where the annualized inflation rate is up around 5% in the US, about 3.8% in Australia. So the question is significant inflation coming, or is this transitory? And that just means, is it temporary, or is it a trend? Is it actually going up? And spoiler alert, we actually think it's transitory. and our good friends at Franklin Templeton, who do some amazing research on this, have got some good charts here that sort of show why this. And you'll see the top chart here shows in the US used motor vehicle prices, and like our experience in Australia, they've absolutely exploded during the pandemic, and that's because new cars aren't rolling off the production line. So the value of used cars has gone up, and that flows through into CPI. You've got things like timber, and timber has been hard to harvest and transport during COVID. So we've seen timber prices go up as well. And yeah, in New Zealand, we see the end result of that, which is New Zealand House Price Index, which is up 30% of the cost to build. I'm hearing similar stuff anecdotally from builders here in Queensland that the cost of new housing is up around 30%. Now, will that stick? Will that come down? What a lot of the experts are saying is these price pressures will be resolved as the world comes back into normal. New cars will roll off the production lines. That means people will start flogging their used cars, and we might actually see used cars get smashed in prices. Not to mention used caravans, used boats, and all the other things people have bought during COVID as new stuff becomes available, but also as alternatives to spend your money on becomes available. While we haven't traveled during COVID, a lot of us have spent money on house renovations, cars, caravans, boats, and those types of things. And the same with lumber. As the world gets back to business and that ships around, we probably will see downward pressure, and hopefully that transitions back to prices. So there's a few examples of things that are temporary. And if we compare, and this is Franklin Templeton's work again, the great inflation of 1965 to 1982 versus post-COVID, and things are not, we're nowhere near in the same status. I mean, for one, in the late 60s, we had a crazy share market boom driven by companies like IBM, Kodak, and what was known as the Nifty 50 in the States. And that led to a bust as inflation came in. But we have also, and I didn't show the numbers here, but unionization in the States has dropped from 35% in the 60s down to about 12%. Australian numbers aren't dissimilar to that. So it means less collective bargaining, less unions trying to build their wages up to be fair. And in terms of demographics, we've got completely different demographics. We've got slowing population growth at the moment compared to fast rising populations in the late 60s. Monetary policy and easy fiscal policy is the only two things that these timeframes have in common, but we don't have commodity prices going crazy. In particular, oil. Back in the late 60s, we had the Suez Canal crisis, Middle East tensions that gave us the first oil crisis, and oil prices shot up and stayed up. And that was one of the biggest bits. And strong wage growth, that found its way into wage growth, which we don't have at the moment. So it's highly likely we're not in a scenario like that at the moment. And you can see already in the underlying monthly figure that comes out of the States for underlying CPI that excludes food and energy, it's starting to drop off already. And these are the monthly numbers. So you can see the peak there a couple of quarters ago and starting to drop off already. So in answer to that question, I do think inflation is transitory at the moment. Not to say it's not going to go up, but here's where the forecasts come into. So the RBA's own forecast on the right here has inflation, and it's the headline inflation numbers popped up to that 3.8%, but it shows it coming back down and settling in at the high ones and twos over the next few years out to 2023. And that's why the Reserve Bank is talking about not raising rates till at least 2023, 2024. And they've talked about that they're not going to raise rates till they actually see that long-term number come into that 2.5% sort of window. And one of the best indicators of where inflation's going is the yield curve. And the yield curve is just the interest rate you get on bonds of different timeframes. So at the moment, we've got almost zero for short term, up to 2 years. A 10-year bond at the moment at about 1.7%, and a 30-year bond, which you can actually get, but are very rare. You get a whole, I think it's about 2.5%. So imagine investing your money for the next 30 years and you're guaranteed to only get a 2.5% return. Now, why would people do that? Because they think there's no inflation. So the bond market is saying they don't think inflation's coming. And what you will see if the bond market thinks inflation's coming is you'll see this yield curve start to steepen and the numbers start to go up. During the 80s, for instance, the 10-year government bond in Australia reached a peak of 14% as inflation was up around that number. So yeah, we're not seeing that in the bond market. So that partly confirms to me that we're at that low rate. A quick update, but our 4 pillars remain exactly that, pillars and long-term basis that we use to provide our long-term investment decisions, which is very different from short-term speculation or trading. And I've talked about a few of those things. So Aussie shares down for the month like most markets, but still a healthy year. We're showing 1-year returns still at about 30%, up from those COVID lows or partly those COVID lows. But Aussie is very boring over the last 10 years, about 10%, which is bang on their 100-year average as well. Not much change to the top 10 in the ASX 200. And yeah, no change at all to those companies. US shares also backwards in September. Most of the gains, most of the drops in September, by the way, have since starting to recover. So we're seeing the markets heading up again. They dropped a little bit more at the first bit of October, but heading north again. And you'll see once again the top 10 in the US, driven by those big, amazing technology company, Apple, Microsoft, Amazon, Facebook, Google, Tesla, dominate, but a few old school ones in there, including JP Morgan and Berkshire Hathaway, Warren Buffett's company, sits in there as well. And those companies all reported good increases in profits. So despite some companies like Tesla having extremely high price earnings ratios, 125, most of them aren't in crazy territory. Berkshire Hathaway is always only about 20. So we think the US market, fair to expensive, it does have a 10-year return of nearly 20% from the Australian perspective. Part of that is a drop in the Aussie dollar over that period, and part of that is the increase in profits in the US market over that period. US small caps, a tremendous 1-year run at about 55%, 5-year return about 15%, dropped back a little bit for the month. But this is where the action is in the States. And even though we say small cap, it's really mid to large caps. If you look at the top company in your holdings in this one, it's Macy's, a department store. And Macy's is about the same size as Woolworths here in Australia, which appears in our top 10, but is a small cap. It appears in the top of the small caps over there. So these are big, solid companies. And in that portfolio, you've effectively got a share of 600 companies. That is massive diversification and a big spread. You've got things like Macy's on a PE of about 10, extremely low, which counterbalances some of those high PEs of companies like Tesla, etc. So we've got US small caps and mid caps at just over fair value, and certainly not in any scary territory. Global leaders have had an incredible run, and that is because they're dominated by those companies I talked about a minute ago, but also some of the other not tech companies like Nestle, Procter & Gamble, Samsung, etc. And those companies have continued to do incredibly well. We've got that at fair to expensive, so it's probably the most expensive part of the market that we hold. But we don't say that with any fear, because the companies in that sector are actually producing fast rising profits, which is justifying their price earning ratios. So we hold that gladly, although we do watch that one closer than the other ones. Emerging markets, a negative month, and this is the area that of course includes China. So the emerging market downturn, post that the Chinese Evergrande scare is probably worse than the others. But this is an interesting one. Emerging markets, we would normally expect to grow by more than developed markets in the long run, just like small companies grow by more than developed markets. But in the last 10 years, they're only at 8%. So compare that with 10% for the Australian market and 18 to 20% for the US. So we see a potential rise in emerging markets, and we think they're fair, potentially even slightly cheap as we come out of COVID. And we see those areas return to that focus of being the fastest growing areas on the planet. So that's China, India, etc. Gold, another negative month. So it's now a negative year, down 8%. But gold's an insurance policy for the portfolio. We don't mind if it's down a little when everything else is up. It only plays a small part in your portfolios, and it is a hedge there for if inflation does emerge. And part of the reason it's down is because we're just not seeing inflation emerge. Property prices, what can we say? All dwellings at the moment up around about 20 to 25% over the last 12 months. Quite amazing. Houses even higher, 28% in Sydney. Melbourne not quite so much, 17%. Brisbane, including the Gold Coast, about 23%. I think the Sunshine Coast is higher than that. I think it's 30 to 40% off a lower base. Brisbane 22, etc. And units similar but not the same. And units is an area that, particularly in the inner cities of Sydney and Melbourne, haven't grown by as much, but some units in some areas are doing well as first home buyers enter the market. So what does all that mean? A few charts just to sort of help our thinking about property. This chart in the top left from Trading Economics shows the growth of property market by quarter, and you'll see that we're high, but not crazy high, similar to we've had in other quarters, but starting to build. The chart on the bottom left shows Brisbane, Brisbane's growth compared to the rest of the capital cities, and you'll see this period from about 2012 all the way up till last year, where Brisbane underperformed the rest of Australia, and it was partly because the interstate migration that you would normally expect to Queensland didn't eventuate for whatever reason. But we're seeing that reverse, and during COVID, and we expect that may continue to reverse post-COVID. So that's going to bring more people into Queensland. We can see for the broader, and reason we look at population growth is population growth drives property growth. And you'll see here the net migration, Australia's population, actually coming down over the last bit. So the ABS numbers, which is census-based, etc., only go through to 2020. But the numbers that the economists forecast, which will be confirmed by the census, shows complete drop in overseas migration, and even a drop in natural increase, and that's starting to pick up again. And if you look at the regular bit, we saw net overseas migration peak at about 410,000 for the year ending 30 September. Now, Scott Morrison made a comment in something the other day that was about 350,000 plus people coming back from overseas. So that's Australians returning from overseas. So one of the great unknowns, what we're going to see as the world opens up, we're going to see two things happen. We're going to see people come into Australia from overseas. The Australians that couldn't return home. We may also see some of the Australians that returned home head overseas again for their work or other bits, but we will see the normal immigration start to return. So we had that negative year in 2021 to the end of September, but we would certainly expect to see that bounce back. And that will be a positive for property prices. I do expect property prices will stabilise next year. As people start to look for elsewhere to spend their money. It's hard to see it reversing while interest rates stay so low, and we still think interest rates are staying low. And a lot of the new money that's come into property has been borrowed at rates around 2%, and some of that's been fixed, so it might be a while before we see mortgage stress on those things. And in general, Australia's percentage of borrowed to buy property is reasonably low compared to the property stock. So not seeing any danger signs there. And we're actually seeing the Reserve Bank and APRA make changes there, not to interest rates, but to make it slightly harder to borrow. And they may increase the debt to income ratios, which means that would stop banks from lending to people above a certain percentage of their income. So all these things have probably put a dampener on short-term property movements. We still believe property is a great long-term investment. It'll be harder to find great returns in the next few years, but in the long run, there is always opportunity. Our friends at Heron Todd White, the property clock here shows everything rising, quite staggering. Everything rising, a few things at the top, but nothing in decline at all in Australia. Quite amazing, something I've never seen. And it's going to be interesting to watch the next year. So just summing up as I wrap up, we go back to our core belief that all the best investment decisions are best made as part of a real financial plan. And that's where you've got your goals based on who and what's important to you, and a portfolio and investments designed to meet those goals, where we take a long-term view that's risk managed by diversification, smart asset allocation and liquidity. We aim to be below opening costs through low-cost index funds for most of those growth markets, and to protect against short-term volatility through reserves and dollar cost averaging, reserves for our retired clients, dollar cost averaging for our wealth builders. And we rebalance regularly. So you'll see some little changes to some of the portfolios come through this month from our rebalancing activity. We know that adds 0.5 to 1% to returns in the long run, which effectively pays for the process. And a reminder, there is only 3 ways to lose money on the share market. That is panic and sell. When you need the money, you have to sell because you need the money. And thirdly, not properly diversified. We tick all of those off to make sure you don't do any of those, which makes sure you get to enjoy the good long-term returns that the share market and other markets bring. I wish you all the best as I wrap up there. And I can't believe it. We're starting to roll into November and December. So next month I'll be talking about Christmas. 2 more of these before we do hit Christmas though. But I can hear the fatigue in people's voices. People are looking ahead to Christmas and a break. And for a lot of us, we're getting excited about being able to get out of the state. Well, not so much get out of the state, but come back to the state if we get out of the state. So wishing you all the best with that. So till next time, this is Rob McGregor signing off.